I have heard quote that gentlemen prefer bonds. Did you know who that said? Actually, this was one of the richest men in history of modern capitalism called Andrew Mellon. He told that bonds were more mature, more predictable instrument as opposed to stocks, which were at that time something similar as not today's S&P 500 stocks, but some sort of altcoins. That was his rationale. And I thought to myself whether this quote actually applies in today's market, specifically for Europeans. So I did some actual digging, and what I found out was that actually answers kinda, I would say, mixed, as it is with everything in financial markets, because from one side, European bond market is really boring if you are looking at like government bonds or high credit rating corporate bonds, because the interest is so low that it's still below inflation rate. It was low in early 2010s. It's still really low right now. So if you invest in like German bonds, that's not for gentlemen, that's instrument if you want to lose your money. But here the thing goes interesting. If you are looking at corporate bonds which are not of the highest credit rating, you might see interesting stuff. For instance, in Baltic states, where I am from, you could see actually many bonds that have been yielding like 8 to 12 percentages per annum, which is pretty outstanding. It might seem that these kind of bonds are actually junk which is issued by companies which will soon to go bust in order to refinance themselves to linger around for 1 or 2 years. That might be true in many cases, and actually there are specific, I would say, circumstances where I would deem these bonds exactly like that. But from other side, there are actually issuers who are issuing these types of loans like 6, 8, 10% per year for years, and been quite successful in their ability to pay them. So, you know, if you look at the right places, I would say this is really interesting. And this is specifically like Baltic states and this market, because I believe there is the issue that companies actually cannot get their financing right from the banks in direct ways, which is way easier in Western Europe, I believe. So they have to pay something extra to get their financing done. And this is the way how they are doing it. It's, I would say, 10 times easier for them to issue bonds or go to investment platforms to get their loans rather to go to banks. And for now, it's kind of working. Whether these kinds of opportunities be here for like 10 to 20 years from now on, it's impossible to say. But one thing I could say from fact, unless you are like hedge fund which has to invest like $500 million in bonds, but you are more, so to speak, retail investor, there's a really good chance that you could find something really interesting in bond market outside of largest markets like Germany, UK or something like that, which will give you 2 or 3% for 10-year maturities. You know, this will be complete waste of time in my case. I'm not pension fund. But if you are like pushing the envelope slightly higher and yet have some reasonable assumption that they will pay, I would say something like Baltic market is good. Yes, of course, I'm pitching my region, but there is some logic behind it, because if you really diversify and if you really look seriously and try to balance those risks, if you are comparing risk from S&P 500 to bond market, you would see that they are not significantly higher. Of course, if you are like presuming to invest for like next 10 or 15 years with bonds with such high yield, you might realistically assess that there will be many of these issuers which will have a problem to make payments on time every time. So I would believe 100% there will be many companies which will have delayed payments. There will be many companies which have cyclical businesses which probably might have problems with bond solvency. Probably something like real estate companies might be at risk slightly higher than other ones. Yet at the same time, there will be some companies which will be able to pay those bonds way better because their business model allows them to do that, you know. So there are always pros and cons, but if you diversify wide enough, I don't see how the overall risk might be higher than if you were to invest in S&P 500, because in both cases you might have some risks. In S&P 500, the largest risk, of course, is the fact that we have historically high markets with really high valuations from one side, and from other side, the historical returns in like past 10 to 15 years have been remarkably high. So what are the possibilities then for next 15 years we might see identical rise in S&P 500? Well, chances are, I would say, that they will gradually go to 10%, which is historical return. That means it had to be slightly lower in like next 5 to 10 years. That's the largest risk, and that of course will involve the fact that we might have some significant corrections or bear market in the times when we have the least expectation of it, because that's how markets are crashing. So that's the one risk in S&P 500, and if we compare that with diversified portfolio of fixed income security, for instance like Baltic state bonds, then probably I would say the upside is that on general we are kind of expecting fixed return for next 15 years, but we have to realistically assess that some of our portfolio will be underperforming, some of them will delay payments, and maybe out of 20, one or two might be insolvent. That's, I would say, reality. Not one or two, not 15 or 20 out of 20. That's what I meant. So this is my presumption. So if you stick together S&P 500 portfolio and bond portfolio, for instance, from Baltic states, then you might have fully stacked portfolio, which overall have pretty good combination of stability, plus I would say sort of long-term integrity. And I would say it wouldn't work any worse than fully invested portfolio with S&P 500 as a main source of your income. Of course, if you want to have safety, then you have to have different path, and you have to simply go to safest government bonds or safest corporate bonds and realize the fact that best thing you could match is to have income within bond market, which would be probably break even or slightly negative if we incorporate inflation and capital gains tax. And that's reality. So in modern world, gentlemen prefer bonds which has some sense into them. These are not years when we could invest in highest grade bonds and make more than inflation. We still live in era and in place where if we invest in safest bonds, we will make less than inflation, and if we want to take another path, we have to invest in something more riskier, and that we have to diversify properly. This is the reality. And of course, if you are investing in Europe, I strongly suggest that you don't invest in bonds which are denominated in different currency rather than euro, because then you have to take into consideration currency risk, and in many cases currency fluctuations might be way larger than changes within bond prices. So that's one fact to which I would stress strongly to any investor, that you should only invest in fixed income securities which is denominated in your own currency. If you don't have possibilities to hedge currencies cheaply, that means if you are not an institutional investor, avoid different currencies. So for Europeans, either realize the fact that you have to invest in something really low yielding but safe, or push your envelope slightly higher. For instance, you have opportunities here in Baltic region, and I believe probably there you have similar opportunities within corporate bonds on each of the regions if you look properly. But for that, 100% diversification is needed, and then you have also assessed the fact that you might have some defaults and you might have some problems with bond payments for some percentages of your portfolio. That's like reality of the fact. If you accept it, if you lived it, you're all set, because we all have risks in life and in financial markets. The more realistic we are to those risks, the better we are with our lives. So that's the reality. So accept that reality, and then European bond market might just be for you. But this is like my general thoughts about European bond market. I think we will go into specifics pretty soon.